The elite are always in the know. They are aware of what's going on at any given time far in advance of the general public. It is a documented fact that insiders usually wait until stock buybacks to push up the price and then sell off a portion of their shares. These executives have benefited greatly from this throughout 2018 and will most likely continue to do so until the next crisis. Are they on to something, or are they making a foolish mistake? You came here for the truth, so let me unveil that for you. Today we're going to talk about the Federal Reserve. We're going to talk about stock buybacks. I want to talk about real estate and everything that has to do with interest rates and this monetary system. Let's begin by taking a look at this. You probably saw the news, but the Federal Reserve increased interest rates yet again, and they are now moving up by another quarter point. Now, this is very significant because we are getting closer and closer and closer to that dangerous territory. I have said that perhaps it would be historically impossible for them to get along with a 3% interest rate. That would mean mortgage rates are significantly higher than they are today. That would mean everything that has to do with financial transactions is going to be too expensive in order to deal with all of these things. I mean, look at the national debt and the interest payments they have on that. That's all going to increase as long as the Federal Reserve continues to do this policy. I think it is excellent that they do so because they need to cool it down. There's too much borrowing, too much debt, too much leverage, too much margin, and that is all because of this one thing. Now, if they change it, other central banks around the world start to get intimidated and have to respond accordingly. They start tightening, and we've got ourselves a crisis in the future. Now, you might say to yourself, why would they do this? Why would the Federal Reserve act in this way? Why not just hold off on interest rate increases and let it ride? Well, you can't do that forever because of the pressures which are applied beyond just typing a number into a computer. We are talking about open market operations. This is what the Federal Reserve does, and they have to print money in order to do that. They know they can't do that forever, and they are tightening. They're doing it too late. They're doing it too slow, but here we are. They claim that they're going to do another increase this year. We'll see if they do so. That would be 4 increases in 1 year. That would be a record for them this time around in this cycle. I want to see it go higher and higher and higher because we need more stringent, more tight guidelines, and that has been a long time overdue. The Federal Reserve on Wednesday raised its key interest rate for the third time this year and signaled one more hike in 2018, most likely in December. So we'll see how that goes. I'm going to bring it to you, obviously. The Fed removed language in its statement that referenced, quote, accommodative monetary policy even after the complaints of rising interest rates. Now, we have to see this, as I argued just a moment ago. What's interesting is that they actually look through these statements, these meetings, and they look for particular words. Now, this word in this case happens to be accommodative. I think it's interesting that literally the words that they use affect the stock market greatly. And in this case here, they are trying to make it more stringent, more tight, but we'll see how that actually goes. It's been way too slow. I mean, the first increase was, if I remember correctly, December of 2015. So we went all the way from the crisis, March 2009. They claimed everything was fine in 2010. So up until 2015, they left interest rates as basically 0%. That's ridiculous, but hey, that's where we are. It raises forecasts for economic growth next year. Short-term borrowing costs are most affected by the Fed's decision, so interest rates on things like credit cards should increase soon. It's not just the credit cards, it's not just short-term, because it does have an impact on everything globally. I want to extend that out. Yes, direct impact might be short-term borrowing costs, but look at mortgage rates and what's going to happen here. Of course, they're going to increase. They don't have to. Banks don't have to, but they will. That's what happens every time, all right? Looking at the interest rate itself, this is what I try to show every single time. I think it is absolutely critical to understand this. Now, we can look at this. This is the peak, 1980. But even if we excuse that peak and we bring it down to, something around, let's say 10% or a little higher, which is historically high but not extreme, we could look at this and see what has happened. Every single time we go through this, my line is not exactly to scale here, but you get the point. We can never get back to the previous high. So How much higher can we get? Some people have said 2.5%. People say 2.75. I think around that 3% mark is going to be very dangerous territory. I don't know how it can be sustained. I'm not saying it can't go higher. It absolutely can. Look at what happened in 1980. It certainly can go higher. But how can it be sustained? I have no idea. Beyond that 3% mark, that's just an arbitrary number. Of course, I'm not making any predictions. I would just really like to see it. I'm looking for 3%, and then going to see how the market is going to behave as a result. So you can keep an eye on the Fed funds rate. I think it is the most critical thing. People are asking, what do I look at for real estate? What do I look at for the stock market? And I think really the Fed funds rate is the ultimate indicator that we need to be watching. It is not the end all be all. It is not everything, but everything surrounds it. Okay, so that's what I really think. It's kind of like you have mortgage rates, you have credit cards, you have interest payments on the national debt, and that all is surrounded by the Fed funds rate. It has to do with it indirectly or directly. All right, looking at this is the most important factor that people are not paying attention to today when we refer to what's happening in the stock market, and that is two factors: buybacks and selling off the shares from executives. Executives are selling off their company stock at a record pace. Oh, don't worry about it. It's just a record pace. Nothing to concern ourselves with. Nothing to worry about. The insiders, I think it's Microsoft CEO or one of the highest level people there, sold off 30% of his stock. Oh, it's okay. No problem. Nothing to worry about. Corporate insiders are dumping stock in their companies at a rate not seen in 10 years. With September not yet over, stock sales by company executives reached $5.7 billion. According to the data by TrimTabs, the highest September in a decade. August, $10 billion in insider sales also reached a 10-year record high. So we're going back into that territory right before the financial crisis. Are they in the know? Do they know something we don't? Or are they simply just taking profits? This is all part of the act. But what I think is interesting is that they seem to always wait for a stock buyback. So they do a stock buyback, prices get pushed up higher, then they sell. To me, that's concerning. That's concerning what they're doing. I don't know how it's legal. If we're going to make it legal, why isn't insider trading legal for everybody? It's only for a select few people. At the same time, stock buybacks are roaring ahead, pumping up U.S. shares to new heights. Companies this year have announced $827 billion in spending to purchase their own shares, well above the buybacks that took place during all of 2007. That was a previous record. We can see here that they are going to go over $1 trillion in stock buybacks. Now, you would think to yourself, why buy your own stock? If you're going to spend, let's just make up a number, $100 billion in stock buybacks for your company this year, wouldn't it make more sense sometimes to be able to give a dividend to attract long-term loyal shareholders? Or maybe you want to go in and buy a new company. You could go out there, purchase a company that would help out your business in the long term. Maybe, let's say it's Apple. They want to do this whole, car company. They could go out there, spend $100 billion, buy that new car company that they want that's already in existence. They could take their engineers. They could take all their company, amalgamate that and have this company. Instead, what they're doing is they're just buying back their own shares, enriching the executives, and that's really who benefits the most out of it. Yes, as an individual, Warren Buffett, I understand what you said, Warren Buffett, how stock buybacks benefit you. It's as if the stock price has gone higher. And stock buybacks generally do push the stock prices higher. That's a fact. However, we need to be looking at it in the real deal, the real detail that people are not focusing on. And it is that why not go out there and purchase other companies? Why not spend in research and development more? Why not put your money where your mouth is? When you say that the economy is roaring ahead, you wouldn't need to worry about that because there's so much growth ahead, but you're not doing that. Something's fishy. Insiders have been committing lots of money for stock buybacks, and they're not doing buybacks because they think the stocks are cheap. They're doing it to pump up the stock so they can sell it. And that is the director of liquidity research at TrimTabs. I completely agree with that in this case, and we're definitely at odds with Mr. Ice Cream Coca-Cola Buffett. All right. This is Hussman. You may have seen me showing the charts before. I read some of the articles from here. It's hussmanfunds.com. he made a comment here, and I just wanted to highlight this before I show you some charts from his site here. They're talking about how the stock market has been roaring ahead. That's obvious. They've been doing very, very well. The S&P, the NASDAQ particularly, they've gone beyond 2000, beyond 2008, beyond the dip, I should say the peak of January of 2018. Here we are today. I am aware of no plausible conditions under which current extremes are likely to work out well for investors. There are a few possibilities that could involve smaller loss than a 2/3 of market cap that I expect to vanish as the run-of-the-mill baseline expectation for the S&P over the completion of this cycle. He's not talking about today. He's not talking about tomorrow. He's saying eventually when it happens. That's a bold prediction. I'm not saying that, but it is quite interesting to see what he has to say. Yet it's worth recognizing that the completion of every market cycle in history has taken the most reliable valuation measures. We identify those best correlated with the actual subsequent S&P 500 market returns to less than half of current levels. Absolutely. The stock market drops. Last time around, it went over 50%. Previous times, we've seen much worse than 50%, and it certainly could happen again. Look, last time they went to such extremes, and it didn't even fix the problem. So if we are to actually excavate the issues, which won't happen, but that would mean a real significant decline, and that would be good. That would be healthy. We'll see if they actually go ahead with that. Now, some of the charts I want to show you here very quickly. Market valuation measures presented as percentage deviations from the respective historical norms. On the bottom, you're going to see all the years going up until present day. On the right-hand side, you see in percentage terms. And we are now in this way, we're looking at so significantly higher than we've seen before. I mean, the valuations are ridiculous today, and you can measure that with the CAPE ratio. You can measure with whatever they're doing here, price normalized forward operating earnings. There's price to revenue, all sorts of things. We've gone beyond that. We've gone beyond that from 2008. It's unbelievable to see the territory that we've brought ourselves into today. Why? Why in the world have they gone to these lengths? Why not allow it to actually be restored? Increase those interest rates. Let reality set in for once. All right. Federal Reserve Economic Database, Standard & Poor's, Robert Shiller. We're looking at their data to see the margin adjusted CAPE. This is something I've shown you before. He describes it here. Won't get into that. Wanted to just show you the fact that we've gone beyond what we saw back in 2008, and even back in 1929. So this is quite excessive. And now to finish it off, builder slump as U.S. housing market shifts to the slow lane. We can see that the housing market is stalling and home builder stocks are feeling the pain. Now, I wanted to show you this specifically because you'll see markets around that are very, very hot. I've been recognizing the fact that the Rust Belt has seen a little boost recently. Why? Because they're cheaper than a lot of other places. So investors are probably coming in, buying those places up, fixing them up, trying to get new neighborhoods to get started up and coming areas. They build it up. You can look at other areas like San Francisco, Manhattan. You could see Miami, LA, other places that have been just off the charts, but it's unaffordable to the general public. Okay, so that's a problem. But there are the average of which have slowed down. That's quite significant that I've noticed here. The S&P Super Composite Home Building Index is down 21% year to date, on track for the biggest annual drop since 2008 when it fell 32%. That's with the tax cuts, unemployment, the fake unemployment rate near the lowest level since 1969, and real estate developer in the White House. What gives? Well, they get into all of this, the reasons why. They talk further into it. I think one of the biggest problems here is that people simply can't afford it. I understand that they can get a mortgage. They do so here in Toronto all the time. They can make it so that you can afford it. And if you can't afford it from a regular bank, they can always go to an alternative mortgage lender. There's always a way around it. There's always a way in. I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting the channel. That's why I really appreciate it. All you got to do is hit that button and you're supporting the channel. Also, you can hit that subscribe button. That's going to help me out as well and help you to be notified of any videos that you're going to see on here. I post every single day, basically. And if you want the financial education you were not taught in school, these 2 books have it all. You're going to get the foundation, the history, the asset classes, everything. Take a look at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.